Druckenmiller says equities risk rewards the worst he's seen in his career. You have David Tepper says the market's the most overvalued ever since 1999 bubble, and the list just goes on. Well, joining me now for her take is Amy Silverman, RBC Capital Markets Managing Director and Equity Derivatives Strategist. Amy, it was like a who's who of high-named investors who are bumming everybody out with their negative outlook for valuation in the equity market. Is the options market pricing in any of that jitter?
So, good morning, first of all, Alex. It had been, and the fears were very high, and that's actually come in very quickly, and in my opinion, probably a little too quickly. We're probably going to start to see the options market reflate again. And what's been interesting this whole time to me is that all I'm talking about is the front end. So the long end of the options market, so how uncertainty looks in the future, has actually been very sticky. And my takeaway from this is this long-term nervousness is still there. So, we're going to be looking towards the end of May to get the full data on remdesivir. I think that's an important catalyst. I think how retail earnings do now, because they're a very high yieldy portion of the earnings market, that's going to be a big deal. But throughout this whole thing, the options market has remained pretty nervous in the, I would call it, 9 to 12 month bucket.
So then on the short term, how and when does that re-rate? Is it going to take retail earnings for the short end to sort of move?
Yeah, I would be watching those, and I think that this is a good opportunity because, option prices in the front end, just to give you two stats, from April 1st to now, the front end has dropped 30 volatility points. The long end has only dropped about 8. So that front end has come in very quickly, and now we have kind of two key catalysts to watch that could drive that downside. So if you're owning volatility now, I'd say that short-term one, especially ahead of these retail earnings, could be a really interesting place to place some short-term hedges.
On a sector basis, are you seeing where are the cheapest places to buy protection? Are you seeing on a sector basis any difference?
So, this is another point that I think is interesting. The parts of, and I'm just using the sector ETFs, but the parts that have come in the most are actually like some of the financials, IWM, and then S&P. And if you actually think about that, most of the underperformance has been more there than it has been in other places. So, for instance, IWM has come in, and then SPY, and then Qs. And those are sort of the opposite of the outperformance, right? So Qs, all your tech has just dramatically outperformed because of FANG. But the places where volatility has come in the most has actually been in that small, mid-cap, and value buckets. However, if we see continued bad news, probably that is where your beta is still going to lie, rather than, what I call the new COVID utilities, which is FANG and FANGMAN.
And talking about FANG for a second, there seems to be an emerging debate also over these names in tech, and that obviously we can understand why they may be more COVID-proof, but they still need to sell their services to companies, and those companies are getting hurt as they provide services for consumers, and consumers obviously can't do anything. Is it time to look at protection from that perspective or not?
I think the answer is yes, and the longer this gets drawn out, the more you're going to start to feel that, despite, the PAL put that has been placed into the market. One thing that we saw the last few weeks going into all the FANGMAN earnings that I thought was really interesting is this overwhelming call exuberance. So normally in the options market, call options are lower than put options in terms of their volatility because most people are long stock and then they're hedging. And in I would say 5 out of the 7 FANGMAN names, that wasn't true. So you actually had call implied volatility levels bid over put and volatility levels, which just shows you how much call exuberance there is. I mean, the only other stock I ever see that for is Tesla. So it just tells you that they've almost reached this cult-like flight to safety. This is where people go when they have no idea what to do. And, I'd be taking advantage of that. So those calls being so big, you can sell that at a greater level to fund put protection than you could at any point in history. And actually, Amazon, for the first time ever during the COVID crisis, its implied volatility levels as a ratio to the S&P went under the S&P. It was the first time that had happened ever in its history.
Interesting. Those are some really interesting comparisons. So I guess also what helps to insulate tech is that it's unrelated to what central banks are doing, which leads me to what central banks are doing. I mean, you don't fight the Fed, you buy what they buy. That's been the mantra for years. And now that they're buying corporate bond ETFs, I wonder how that's playing out in the options market.
Yeah, I will tell you that has been something that we've looked at very closely. So I think it was Tuesday, the Fed basically started its secondary facility to purchase ETFs, which, just the fact that these words are coming out of my mouth is like kind of crazy to think about. Mm-hmm. And you know what I thought was interesting, specifically about HYG, is if you actually read the fine print, the Fed basically put in the high yield portion almost as an afterthought. It basically said, look, we're supporting IG bonds. We're supporting these specific IG bonds that have fallen angel status, but like only in this time period. And hey, we might buy high yield as well. And to be honest, I think the market took that, kind of out of proportion. And just if you look at the rally that happened after the Fed announced that, HYG had like the biggest rally that it had in months. The same with LQD. And now the facility has started beginning on Tuesday, and you've seen 3 days of HYG sell-off. And the options market has become extremely bid in the put wing. So the very low delta, very out-of-the-money puts have gotten very, very steep. We've actually been pitching put spreads there, so essentially saying, look, of course, don't fight the Fed, but, if this thing doesn't work or isn't seeming like it's working and it goes pear-shaped quickly, you're getting very, very good payouts on that downside now.
Really interesting. And then wrapping up with one more part, and that's the dividend and buyback story. If you were buying equities for buybacks, that was not a good idea. And if you're buying it for dividends, that's now in question too. As the longer this goes on, the street's now talking about more dividend cuts. How does that play in to your overall thesis on the market?
So as a volatility person, one thing that I've been looking at very carefully is just what is fair value on the VIX and the VIX curve now. And I think, look, volatility is a mean reverting asset. That's what all the textbooks say. And my one nervousness about that is we're looking at the past 12 years of a bull market where a record rate of buybacks has dampened volatility, because when there's buybacks in stocks, it dampens the downside by offering an artificial level of support. I think 80% of companies during the last earnings have essentially said we're suspending buybacks and CapEx, and dividends are next. The people are trying to defend their dividends, but if they can't, then you chop the retail leg off the market.